Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
All right, good morning, everyone. I apologize that the Thursday workshop recording was not recorded either. So a lot of students email me, so what is the overall course structure for this course? I apologize for those who are hearing this for the third time, but it's really important, so I have to quickly go through the assessment structure for this course again at the beginning of today's lecture. So first of all, you have 6 quizzes, right? And your best 5 quiz results will be counted. And that forms 15% of your overall assessments. So that means each individual quiz only accounts for 3%. So your first quiz starts next week, week 3. All right, so it says in your class schedule, please take a note of this. So your first quiz starting week 3. And please go to your allocated tutorial. All right? Your mark will only be recorded in your allocated tutorial. And the quiz content for next week is valuing for contract. Okay, so I'll go through one example in today's lecture. How do we value for contract? Okay? So that's with the quiz. And also we have mid-semester test, mid-semester exam. So mid-semester exam accounts for 25% of your overall assessment. And this mid-semester test is redeemable, okay? Which means if you do badly in that mid-semester test, if you do better in the final exam, then your mid-semester test doesn't count, all right? But I would still highly recommend you to attend your mid-semester test because it's easier to prepare for it, right? So it's easy mark to get, okay? And your final piece of assessment is your final exam, so 60% of your overall assessments. And your final exam consists of 4 questions. So the first 2 questions is very straightforward. As long as you attend your tutorial, attend your lecture, do your 2 questions, you should be able to do it no problem. Right? Third question is a bit hard. So third question is designed for those students who are aiming for distinction, high distinction. And as I mentioned last week, the last question will be a challenging question, which means that requires a bit of extension of your knowledge, a bit of extension of what you learned. But I'll go through one example towards to the end of the semester. What do I mean by extension question, and how are you going to extend on that? So that's with the housekeeping stuff. And also with the textbook for this unit, it's not compulsory, it's not prescriptive textbook. But again, if you're aiming for HD, I highly recommend you to purchase the book. And the textbook has been out there for a while, so you can buy that from second-hand market for a very low price. And if you don't want to buy it, you can still, borrow that book from ANU library as a 2-day loan, 2-day short-term loan. Okay? And also with the quiz is that next week you're going to sit in your tutorial, and your tutor is going to cover your tutorial content. And they are going to emphasize on the content that will be assessed in the quiz. Then the last 10 to 15 minutes in your tutorial, you will sit down and do your quiz. Everybody understand the format of the quiz? Any question with the format of the quiz? No? So any question with the assessment structure? Okay, and another very important thing I wanted to emphasize is that next week, so the next Monday is Canberra Day. So Canberra Day is a public holiday. Therefore, we have a markup lecture, we have an alternative lecture on Wednesday, right? So there will be no lecture next Monday, but the lecture will be held on Wednesday. And the alternative venue for the Canberra Day Makeup Lecture is on the ground floor of Barry Drive. So this is the address for the Barry Drive, and I will post that information on your Wattle side. Okay, so after this lecture, I will put that location and time here in red color. Okay, so next week, go to that makeup lecture. Yes? Yes, so I have recording. Yes, so I already contacted the IT support team and they guarantee that it will work. And I double checked, so for next week, the lecture recording is not on Monday, but rather it's on Wednesday, so that works. From 10 to 12, all right? So same time, but different location, different date, Wednesday. So don't be confused. And also, I post the consultation timetable here, and also that is the email address for your tutor. If you have any tutorial timetable clash or tutorial reallocation request, please contact admin staff, Smriti. Okay, so that's her email address. Any other questions? Okay, if not, let's proceed to today's content. All right, so last week we talked about the pricing of forward and futures contract, right? The pricing, when I talk about the pricing, I really meant determining the capital F, the delivery price of your forward contract. But today I would like to make a distinction that this pricing formula sometimes doesn't work for something called consumption asset. In other words, if your forward or futures contract is written on the consumption asset, sometimes this formula doesn't work. And first of all, what is the difference between consumption asset and investment asset? So if you think about consumption assets, what we covered last week, something like bitumen. So bitumen is a road paving material that people pave on the road. So people consume that sort of stuff. So that's your consumption asset. And live cattle is consumption asset, right? Cotton is consumption asset. Wheat is consumption asset, something that people consume. And there are investment assets. For example, there are futures contract written on stock indices. So if you think about stock indices, it's a collection of individual stocks. People buy stock not to consume, but to invest, right? And there is interest rate, there is future contract written on interest rate, foreign exchange, and fixed income securities, such as bond. So those are the investment assets. And our pricing formula would always work for the investment assets, and sometimes it doesn't work for the consumption asset. So why that's the case? So in order to demonstrate the rationale behind that, I'd like to introduce two ideas. How do we come up with this pricing formula? We come up with this pricing formula relying on two things. The first thing is called synthetic replication, ability to replicate. And the second is called arbitrage activity, right? We need these two things to make this equation work. So let's start with the first one. What do I mean by synthetic replication? Synthetic replication means that the futures contract / forward contract, so sorry, just one thing. So in this course, we're going to treat forward contract pretty much same as future contract, right? So regardless the pricing formula or the valuation of those two derivatives. I'll explain why we can treat them similar, but now just take for granted, okay? We're going to treat forward in the same way as the future same way as the forward. So the ability to pricing a forward / futures contract is dependent on our ability to replicate that futures contract. In other words, the future contract in this world is really redundant. We actually don't need future contract. We can replicate an outcome of a future contract by using more fundamental securities or more fundamental assets. How am I able to do that? For instance, if I want to buy a barrel of oil in 1 year's time at a fixed price, at a certain price, I have two options. The first is I can enter into a long futures contract written on a barrel of oil, deliver in 1 year time at a predetermined price, at a delivery price that is fixed, capital F. So in that way, I guaranteed in 1 year's time, I can buy that barrel of oil for a certain price. Oh, good. And the second option you have is you actually don't need futures contract, and you can achieve the same outcome. How can we do that? You can think about this way. We can borrow some money from the bank at a risk-free rate. All right? And in other words, we take out the loan from your bank, and we pay the risk-free interest expense. Then we use that loan to buy 1 barrel of oil at today's spot price. Okay, so when I say spot price, I mean today's price. Okay, I buy that barrel of oil today at a spot price, then I put it in a warehouse, I pay storage costs, then I hold that barrel of oil a year later. So in that way, you guaranteed you will have that barrel of oil for a fixed price. So how much is that price? Well, it's the cost of your carry. So cost for you to carry that barrel of oil 1 year into the future. So what is the cost? A year later, for sure, you have to repay the loan that you took out a year ago, right? Remember, we took out the loan to buy that barrel of oil. Now it's the time to repay the loan. Now, when you repay the loan, not only you need to repay the principal, so that's the amount that we took out, and also you have to pay any interest accrued on your loan. So 1 plus R reflect the fact that we're paying the risk-free interest expense. And besides that, remember, we put in a warehouse, we pay some storage cost, we keep it, right? We store it. And that additional storage cost is kind of like additional cost of borrowing to you. So that's why we have S multiplied by 1 plus R plus Q, right? So that Q is like additional cost of borrowing on the top of the risk-free rate you have to pay. And we raise to the power of 1. And all of that together should equal to the future price, the quoted 1 year future price written on 1 barrel of oil. Now, imagine if this two doesn't equal, what is the consequence? Right? If the left-hand side, if this capital F does not equal to the right-hand side, then we can make an arbitrage profit. Think about this way. Just imagine if the quoted future price written on that barrel of oil is greater than the right-hand side. As a smart arbitrager will be thinking, perhaps we can sell it at this overpriced capital F. Right? Why we can sell it at the overpriced capital F? Because we are able to produce the same outcome at a much lower price. So what we're going to do is we can short. So whenever you see overpriced security, you want to short sell it. So you're going to short that futures contract. Shorting means you commit yourself to sell that barrel of oil at this overpriced capital F. Right? You commit yourself to sell, then you'll be thinking, we can replicate this outcome by borrowing some money and buy that oil today, we pay the storage cost. A year later, we're going to deliver that barrel of oil to the counterparty, and we lock in this overpriced capital F, and below and hold this capital F that we made is greater than the cost of carry. So in that sense, we made an arbitrage profit. We made an arbitrage profit because we did not expose ourselves to any uncertainty. Everything is certain. The moment that you short the future contract, you're guaranteed to sell at a capital F price, that's certain. And because you commit yourself to sell that barrel of oil, and you bought it today, so you're guaranteed to have something to deliver. And that's for certain as well, right? So there's no risk exposure there. And at the end of the day, the capital F is greater than your right-hand side. You made a positive profit. So you made an arbitrage profit. Now, arbitrage profit is very nice. A lot of people want to make that profit. So imagine if a lot of people shorting that overpriced future contract, that would push down the future price and eventually bring this equality to this pricing formula. Does it make sense? Now, if that's a little too abstract, let's go through one numerical example, precisely what I mentioned. Imagine the spot price for a barrel of crude oil today is $65 per barrel. All right, so spot price means the price today at the moment. And the quoted 1 year future price of that on delivery of 1 barrel of oil in 1 year's time is $72 per barrel. And also we were told the interest rate is 6%, and the storage cost is 3%. And the question asks, is there any arbitrage opportunity here? Now, in order to identify whether there's any arbitrage opportunity, you have to ask yourself how much it cost me to replicate the outcome of 1-year future contract return on oil. We know how to calculate that. As I mentioned earlier, we can buy that barrel of oil today for the spot price, $65 per barrel, and we're going to borrow some money. We'll borrow at a risk-free rate to buy that barrel of oil, and also we'll pay a storage cost. And because that's 1 year later, so raised to the power of 1, and it turns out cost of carry is $70.85. In other words, the cost for us to replicate the outcome of that future contract is lower than the quoted future price. It's lower than 72. So clearly there is an arbitrage profit there, right? Everybody agree? Okay, so if that's the arbitrage profit, how can we arbitrage it away? Now we know that the quoted future price, 72, is clearly overpriced. Now, if it's overpriced, we are very happy to short sell it. So we're going to enter into a short futures contract today. So we commit ourselves to sell that barrel of oil in 1 year's time. Remember, I mentioned last week, when you first enter into the futures or forward contract, there's no money exchange in hand today. So there's no real consequence today. The cash flow would occur towards the maturity. So there's nothing going on here. And also, in order for us to prepare for the scenario of delivery that barrel of oil in 1 year's time, we better do something today, which is we borrow some money from the bank, $65, and we use that money. So the plus sign means the cash flow coming in, right? So that's inflow. We're going to use that cash flow to buy that barrel of oil for $65 at a spot price, and then we hold onto that barrel of oil 1 year later. So 1 year later, what happens is that you use that barrel of oil to fulfill your short commitment and receive this capital F, $72. Okay, so you fulfill your commitment under the short futures contract. And what else you have to do? Remember, you take out a loan to buy that barrel of oil a year ago. Now it's the time to repay the loan, right? So we're going to repay that loan at an interest rate of 6%, so that's your risk-free. And also remember, we put that in a storage house, in a warehouse, and the storage cost is 3%. So that is the additional cost we have to repay. And the risk to the power of 1. So the amount of the loan that we have to repay in 1 year's time is $70.85. And guess what? The future price that we received under our short future contract is higher than this cost of carry. And we made a profit of $1.15. We made that $1.15 for nothing. Why? Because look at this column here. When you sum up the cash flow in the first column, it cost us nothing to set up this strategy. And in 1 year's time, we made $1.15. So that's why I called arbitrage profit. You made money for nothing. Now, because you're making money for nothing, everybody would love to do it. If everybody doing that, then this overpriced future contract will equal to the right-hand side. So everybody happy with that? Now what about the future price is underpriced? What if the future price is smaller than your right-hand side? What are you going to do? Well, you're going to do the opposite, right? So imagine, so let's start with an investment asset. So a barrel of oil is consumption asset. Let's put consumption asset on hold for a minute. Let's go back to the investment asset. Imagine you have a future contract, it's very rare for a future contract to return on an individual stock. But let's assume there's such contract out there, okay? So imagine there is a future contract written on BHP shares. And that future contract is, let's say, $70. And the $70 is, in fact, less than the cost of carry, less than the synthetic replication cost. In other words, that future contract is underpriced. So what you can do is you can do the opposite. So instead of shorting the future contract, you want to long that future contract, because this time the future contract is underpriced. All right? You long the future contract. Long means the commitment to buy, right? You commit yourself to buy that piece of share for a guaranteed price. And what else you can do? You can short sell the underlying share, right? You can short the share, and once you short sell the share, you will receive a cash proceeds up front. Then you use that cash proceeds, invest in a risk-free, bank account, risk-free interest-bearing bank account, earn the risk-free rate. And at the maturity, what you do is you buy the share under your long futures contract. Once you obtain that share, immediately you return that share to the stock lender, right? The way the short selling work is that you borrow the share from somebody else, you sell it, then at the future date, you return that piece of share back to the stock lender. So in that way, again, you can make an arbitrage profit, and if a lot of arbitrage are doing that, that would bring the equality to this pricing formula. In other words, that would work for the investment assets. Our pricing formula still holds for the investment asset. But let's think about the same scenario with the consumption asset. So this time, the future contract, the underlying asset is still a barrel of oil, so consumption asset. The future price this time is underpriced. Now you'll be thinking, perhaps I can pull off the same trick. Perhaps I can enter into a long futures contract, commit myself to buy a barrel of oil at this underpriced capital F. Then I can short sell the underlying asset. I can short sell that barrel of oil. Now, in order to short sell, you have to find the owner of the crude oil and say, could you please lend me some of your oil? So who are some of the oil owner, crude oil owner? The obvious answer is oil refiner, right? So refinery. So what refinery does is they turn the crude oil into other products. They turn the crude oil into petrol, aviation fuel, and heating fuels, other plastic products. So that's their main course of business. Now, although they're holding a lot of crude oil in their warehouse, in their oil tank, but if you say, can you please lend me some of your oil, the refinery would say no. Why would they say no? Because the oil is not an investment asset. Refinery needs the oil to keep their refinery operational, right? So they need to keep their business running. Imagine if they lend their oil to you, they don't have any oil to keep their refinery operational. All of their employees go home, and maybe some of their employees found another job. By the time when you return the oil to them, they will not be able to do their business. They lost all their key personnel, right? And for that reason, the oil refiner would not lend their oil to you. Even if they're willing to lend, maybe they only lend to you at a small portion. In other words, you are not able to short sell at the amount that you required to make this two sides equal. All right? And as finance people will give that a definition. So that definition is that holding the physical asset would provide you a convenience benefit. And this convenience benefit is otherwise not available to the future contract holder. Right? In other words, holding the physical asset gives you some convenience benefit, and we call it convenience yield. And that yield is otherwise not available to the future contract holder. All right? So if that's the case, how can we make two sides of this equation equal to each other? We're going to introduce something called convenience yield to make the balance. Right? It's written here. So 1 plus R plus Q minus Y. Y is minus. So minus means that this is a benefit. A benefit actually helps you to reduce the cost of carry. So it's a minus sign here. Right? So this equation becomes the spot price multiplied by 1 plus R plus Q minus the convenience yield raised to the power of T. And if you add that component, then this equation would equate, right? Then this equation is at its equilibrium. Does that make sense? Why it's negative? You think about that as additional benefits, right? Additional benefit keep your refinery running, although it's not tangible, but you can think that as, okay, so remember the pricing formula for a forward contract return on stock, right? So stock paying the dividend. The cash dividend is additional benefit to you. Remember how we have 1 plus R minus D, right? Similar here, you can treating this convenience yield as a dividend yield. It's additional benefits on holding on to those underlying assets. So that's the minus sign. Does it make sense? All right, so this is the discrete time version of the pricing formula. And today, I'm going to introduce the continuous time version. So just take this for granted. I'll go back to the continuous time compounding in a second, but just take this as granted. So the capital F would equal to the spot price multiplied by exponential to the power of R plus Q minus Y, and multiplied by the time horizon T. So this is the continuous time version of this discrete time version formula. And in this course, we always use continuous time pricing formula. Okay, so just a little bit more information on short selling. We kind of touch base on the short selling. Yes? Yeah. No. That was a typo. I apologize. So that was a typo. This is the correct one. So the older lecture slide you printed out is a typo. I fixed that. Sorry. Yeah. Yeah, so that T, so you can think about that as S multiplied by E to the power of this whole component and multiplied by T. Yeah, so the T is not, yeah, okay. Any other questions before we move on? All right, so I'm going to come back to the equation later. I'm going to come back to the continuous equation later, all right? So let's talk about short selling. We kind of touched base on the short selling in the previous example that we just went through, right? So short selling means you sell an asset you don't own. It's very easy to do with investment assets, such as stock. So how do you sell something that you don't own? Realistically, in the real world scenario, you call up your broker. You call up your stock broker. You say, I think the BHP share is overpriced, and I want to short sell it. I want to sell today at overpriced price. Then I will return you that stock later when the price drop. I will buy it back and return that stock. And your broker say, that's fine. If you want to short sell, I'll contact my clients. My client will be somebody who is holding the BHP share. Now, usually the client is long-term investor. Think about pension fund and superannuation funds. So for those long-term investors, they hold BHP share in their portfolio for a very long time, 10 years or even 2 decades. So they're going to hold that stock for a very long time, regardless of what's going on with the BHP share price at the moment. So for those long-term investors, they are happy to lend their shares because they are no worse off, right? Because at the end of the day, a year later, you're going to return the BHP share anyway, so they are not losing anything. So they're going to lend you their stock, and you grab that stock, you sell it today, and a year later when the BHP share price drop, you buy it back and you give to your broker return that to the owner of the stock. So the short selling position is closed. Okay? So what if the BHP share pay a dividend while you're holding on to your short selling position? You have to repay that dividend back to the stock lender as well. You have to make sure the stock lender is no worse off. Okay? All right, and vice versa. If you are short sell something such as gold, remember when you short sell the gold, you're borrowing the gold from the owner of the gold, And because you keep the gold, so the gold lender have to pay you the storage cost, right? So it's the opposite scenario of stock. So in stock, when you short sell stock, you have to repay the stock lender the dividends. Now, if you short sell the gold lender have to pay you the storage cost. Does that make sense? Oh, good. All right, so how do we guarantee the short seller doesn't walk away from his short commitment, right? Because let's say a year later, this short seller has to return that stock to the broker and the broker return to the client. How do we make sure the short seller doesn't walk away from his shorting commitment? Similar to futures contract, when you short sell, you have to lodge an initial margin with your broker. And the balance of your margin accounts is marking to the market. In other words, at the end of each trading day, the balance of your margin account is adjusted by the market value. If your balance of your margin account fall below a certain threshold, you have to top up your margin account. Otherwise, your broker would close off your account. So that's how we prevent the short seller walking away from his short commitment. And short selling is, the actual short selling is a bit more complicated than that, because we have a regulation in place to prevent short selling for certain scenario or for certain stocks. So in the US, we have something called optic rule. So optic rule means you cannot sell the share in the company unless the most traded price of that company was increased. All right? So if the most recent price is a decrease, is a fall, then you are not allowed to short sell it. So that's the optic rule in the United States. Now in Australia, we also have something called ASX approved short selling security list. All right? And you can only short sell the stock in that approved list. And you can only short sell up to 10% of the shares in that company. Okay? So in other words, in any point in time, the total amount of short selling can only be 10% of the share outstanding for that company. So that's the regulation in Australia. Any questions with the short selling? Sorry? Yeah. Yeah. I'm not sure. I have to check. Yeah. Personally, I've never short sell any stock because it's very risky. Okay? Yeah. But I can check. So any other question about short selling? All right, so let's move on to measuring interest rate. So going back to that formula, so as I mentioned earlier, so that's a discrete time version of the forward or future pricing formula. And in this course, we're going to use something called continuous compounding. So why continuous compounding? Because in derivative market, things don't happen every year. Things don't happen every quarter. Things don't happen every month. Things happen every second, right? So if you think about the future contract, the marking-to-market scheme means that cash settlement is occur on a daily basis. And we have to reflect that fact. We have to reflect the fact that things are happening all the time into our pricing formula. And we're going to do that by using continuous compounding. So let me motivate continuous compounding a little bit. So I'm going to use this simple example here to recap what you learned from Foundations of Finance. So imagine you have $10,000 investment that earns 15% of interest rate over next year. And following shows the ending value of the investment when the interest rates compounded at different frequencies. Right? So we're going to start with something really simple. So this 15% only compound once per year, so annual compounding. What that means is you take that $10,000, multiply by 1 plus 15% raised to the power of 1, then that's your ending value. That's your future value. How about semi-annual compounding? Well, you take that 15%, but you compound twice a year, every 6 months, and which means you're going to compound 7.5% in the first 6 months and 7.5% in the next 6 months. So which means that's going to happen twice in a year. So that's 2 multiplied by 1, and each time it happens at a rate of 7.5, so that's 15% divided by 2, and then that's your ending value. Same story goes to quarterly compounding. So quarterly compounding means that 15% is going to happen 4 times in a year, right? And each time is 15% divided by 4, and that's your ending value. Now, when we move all the way to the daily compounding, you see that the frequency, if we use the notation M to denote the frequency the interest rate has been compounded, that's M equal to 365, and that's going to happen 365 times in a year. Now, what if I take that M in the denominator and in the power here to the limit? What if I compound at an infinitely small time interval? What's going to happen? Well, mathematically, if you take that to the limit, what you will get is a continuous compounding. So, which means the $10,000 multiplied by exponential to the power of 15% multiplied by 1. So the time horizon with continuous compounding is expressed in a fraction of a year, right? And then you will get this ending value. Now, if you compare the daily compounding with continuous compounding, if you round up to the nearest whole number, you realize they are very similar, right? Because the continuous compounding is very easy to work with. It's easier to work with in terms of discounting and bring stuff forward. So we're going to use continuous compounding throughout this course. Unless I'll tell you exception, okay? Unless I tell you otherwise. Okay, so that's with the continuous compounding. Yes, so that's what I mentioned. I said I will detail any exceptions to this rule as we progress through this course. Right? Unless you're told otherwise, you stick with continuous compounding. Okay, so here is one example. Here's one example. It says, if a nominal rate of 10% per annum is compounded continuously, what is the effective rate? What is the effective rate? In other words, it's asking you, what is your actual earning over a course of a year? Now, in order to answer that question, we can take $1 and continuous compounding at a rate of 10% at a time horizon 1 year, and what we'll get is $1.10, right? So to work out what is your actual earning over the course of a year, we simply subtract 1, and our actual earning is actually 10.51%. So the effective rate for this nominal rate 10% continuous compounded is 10.51%. How are we doing with the time? Okay. So last week I forgot to give you guys a break. So today I'll give you guys a break, but let's do that maybe after 10 minutes, okay? Let's keep going. So, because we have a lot to go through today. No, we're not going to do the break now. I said we're going to do the break 10 minutes later. Sorry for that. All right, so let's keep going. So that's the discrete version that you learned from Foundations of Finance. You take the present value, you multiply by 1 plus r raised to the power of t, you get the future value, and at the bottom of this panel, it shows the continuous time version. Now, with the present value discounting with the discrete time, what you do is you take the future value, you divide by this discounting factor. So the discounting factor is 1 plus r raised to the power of t. But with continuous discounting, what you do is you take the future value, you multiply by e to the power of minus rt, and that would give you the present value. Right? You simply put a minus sign in front of the rt. That means you are discounting it back. All right? And sometimes what question would give you is question would give you annual nominal interest rate. And in this course, because we always use continuous compounded rate, so you have to use this equation below to convert annual nominal rate to a continuously compounded rate. Right? So imagine if I tell you the nominal rate is 10% and semi-annual compounding. So semi-annual compounding means it's compounded twice in a year. So M is denoted as the number of times this interest rate has been compounded. So we're going to put 2, we're going to substitute 2 with this M. So 2 multiplied by the natural logarithm. Okay, so that's the natural logarithm, bracket 1 plus. So that's the numerator is the nominal rate. The denominator is the number of times it's been compounded. So that's 2. And what it will get is a continuously compounded rate. And here are some examples. So we have the nominal interest rate is 10% per annum, compounded weekly. So we have 52 weeks in a year, which means that will be compounded 52 times in a year. So it's 52 multiplied by natural logarithm, 1 plus 10% divided by 52. And the continuous compounded version is 9.99%. Right? So same story with quarterly compounding. So that's compounded 4 times in a year. And you take that 10% divided by 4. And what you will get is 9.877%. So in other words, when you are given a question, read that question carefully. Identify what sort of interest rate you are given. If it's not in the continuous compounding, use this equation to convert that into continuous compounding. Then use that as input to do the pricing of the forwards or futures, and use that interest rate to do valuing forwards and the futures. Okay? All right, what if I give you a periodic rate? So here's one example. What if I tell you that the nominal interest rate is 1% per month? What is the equivalent continuously compounded rate? So it involves 2 steps. The first step is to convert that periodic rate into an effective rate. Right? So it's per month. We want to convert that. So how much you actually earn per year on an annual basis. So that's 1 plus 1% raised to the power of 12 minus 1. Right? So that's the way you work out what is your actual earning over the course of a year with that 1% per month. And you work out that's your effective rate per annum. Then that happens once per year. Okay, effective rate means that happens once per year. And then you substitute that rate into the formula I just given to you. So I mentioned effective rate means happen once per year, so we substitute 1 for the M, multiplied by natural logarithm of 1 plus that rate divided by 1, and you'll get continuously compounded rate is 11.94%. So what I want to emphasize here is that when you're working through, when you have the working procedure throughout the question, keep as many decimal places as possible. And when you get to the ending result, you can round up to 3 decimal places. All right? So just do what I do here. Store as many decimal places as possible in your calculator. As you know, then to the final result, you can keep up to 3 decimal places. Does that make sense? All right, so let's take a 5 minutes break instead of 10 minutes break because we have a lot to go through today. I apologize. Okay, so we're going to resume our lecture 5 minutes later. 30, these two prices will equal. If they don't equal, then there will be upside profit. Yes. Today, sorry if I go on that. So today, let's assume it's January 2019. You enter into a 1-year loan future contract on delivery of gold 1 year later. So, so you would spot price using the formula. So using that formula I taught you guys. So that you simply take the spot price today, multiply by e to the power 5t, then you get a future price. Now fast forward until December, 12 months later, right? 12 months later, he wants to enter into the same contract by 1 ounce of gold 1 hour later. So imagine you're standing in December, this contract is about to expire in 1 hour's time, and he enters that. And that futures price on the same maturity date has to be equal to the spot price. Has to be equal at that time. If it doesn't equal, then you and me, we can make an arbitrage profit. Why? Because imagine only 1 hour left to expiry. If the contract price is a lot higher, let's say you end up here a lot higher than the spot price, what would happen into a long futures contract? Short futures contract. So he's going to commit himself to short at the higher price. All right? And then what he can do is he can buy the gold in the spot market for the lower price and immediately fulfill his short position. And then he make an arbitrage. That would push down to equality. Okay? Now, the vice versa. If the future price end up being lower, he can enter into a long futures contract. All he needs to do is just wait for 1 hour, and 1 hour later, he buy the gold at a lower price. He needs to dump that into the spot market for hard. Push the price up to the conversion. Yeah.
If you convert it from effective annual rate to continuous compounding rate, is it the same?
So effectively, same formula. Effectively, simply you replace the m with the 1. So now the m depends on the scenario. So if I told you it's compounded quarterly, then you substitute 4 for the m. But same formula. But just be aware of the m. The number of times. No, but I'll teach you how to do the extension. It's not in the textbook. It's not in the textbook. Like if you read textbook, you have more understanding of what do I mean by synthetic replication and what I mean by like convergence and why they converge. If you don't want to buy the book, statistical stuff, because I will not examine those stuff. What I will be examining is the concept, finance concept. All right. So this course is finance course. It's not about stats. Concept, formulas, and the logic. All right, guys. So 5 minutes up. Let's resume our lecture. I apologize for the short break because we lost a couple of minutes. Class summary, the unit outline at the beginning of the lecture. So I wanna make some time back to finish this lecture because we have a lot to go through today. All right, so resuming the lecture, so now we're on the slides 20. Okay, now I will formally introduce the forward futures pricing formula, but before I do that, I'd like to clarify, because before I just take things for granted, all right? I made some implicit assumption. So here I'll make those assumptions explicit, make them clear. So the first assumption is that the market participants in the derivative market are subject to no transaction cost. Well, at first glance, you'll be thinking, this is not very realistic, because when we trade stuff, we pay transaction cost, right? But wait a sec. In this course, the kind of investor we're talking about is marginal investors. So what do you mean by marginal investor? Marginal investor are the investor who has the ability to determine the security price, who has the ability to change the security price. In other words, they have to be really large investors. They have to be large institutional investors. And for those investors, they're buying securities in bulk. And if you think about that, then the transaction cost is almost negligible for those marginal investors. So the first assumption, we can accept that. Now the second assumption, they are subject to the same tax rate on all net trading profits. Well, it can be realistic, because if you think about the hedge funds, they have the same tax haven. You know, their headquarters is probably registered in some small Pacific islands. So maybe they can access the same tax rate. Let's just take for granted. Let's just assume that is somewhat realistic. And they can borrow money at the same risk-free rate, and they can also lend their money at the same risk-free rate. It can be true because they are large institutional investors. They can access to some rates such as LIBOR rate, which is really close to the risk-free rate. So that assumption can be true. And lastly, they take advantage of arbitrage opportunity as they arises, which is very true. That's what hedge funds do, right? That's what hedge funders do. They arbitrage, they take a long short position, they arbitrage away the arbitrage opportunity. All right? Another thing I wanted to clarify is that in this course, we're going to treat forwards and the future pretty much the same way, although they have some minor difference. So one of the difference is being the feature of the futures contract, the feature of your futures position is marking to the market on a daily basis, right? So I mentioned last week, the balance of your margin account is adjusted daily based on the market price. Then what happens is that the exchange would calculate your daily gain and losses, then post to your margin account, then that becomes a daily cash settlement every single day. So that's the cash flow pattern with the futures contract. On the other hand, with the forward contract, there's only one single stream of cash flow. And that cash flow occurs at the maturity date. So that's the only difference, only main difference. And if we make assumption that if the interest rate is constant throughout the time, right? So if the interest rate is flat, it doesn't change over time, then we are comfortable of treating the futures the same way that we trade forwards. All right, so that's another assumption that we're making in this course. And here just reiterate what I just mentioned with the consumption assets versus investment assets. Here it mentions a strategy of synthetic replication. All right, so how do we derive the future or forward pricing formula? By synthetically replicate it. Let's assume we want to achieve the same outcome of a short forward contract, right? So we want to short a commodity. Let's say we want to short 1 ounce of gold. We want to sell 1 ounce of gold in 6 months' time. Now we can do that by using more fundamental securities. We can borrow some money from the bank, so that's the money coming in, borrow, and incur the cost of carry. And then we use the same money to buy that unit of gold, all right? And what happens with that unit of gold in 1 year's time is that the gold changes in value. So the gold value would become the final spot price at the maturity date. So that gold value changed from S0 to ST. So ST price is the final spot price. And then you use that unit of gold to fulfill your short commitment under the forward contract, right? So you commit yourself to sell at F price, the capital F price, and the F minus S represents your payoff on that short forward. Why does that represent your payoff? Imagine if the spot price in the future is a lot lower, then you are able to sell at this capital F price at a higher price. So you can sell at a higher price compared to everyone else is selling at the spot price. So you're making a positive profit. Now, if the spot price is a lot higher in the future, you're making a loss. So that represents the payoff on your short forward contract, right? So everybody's selling at ST price, a lot higher price, but you're locking to sell at a lower price. So that represents the payoff. And what's going on here? Remember, we borrow some money and we buy that ounce of gold. Now it's the time to repay the money. We're going to repay that money with accrued interest. So that's S0 multiplied by e to the power of RT, and that money is gone. So that's a minus sign in front of that cash flow. So if you sum up this column, if you sum up this right-hand side column, what you will realize is that this ST in the second row will cancel out with this ST on the third row, right? So plus, minus cancel each other out. What you're left with is F minus S0 multiplied by e to the power of RT. So this whole component has to equal to 0. The reason why it has to equal to 0 is because it cost us nothing to set up today, right? So the net cash flow for today is 0. If you cost nothing to set up today, then that is worth nothing. So this whole component I wrote here is equal to 0. And if you rearrange this equation below and hold, you'll get our future pricing formula, F equal to S multiplied by e to the power of RT. So this little table here demonstrates the logic how we derive the pricing formula for the futures contract, futures and forward contract, right? So I talked about this at the beginning of the lecture. Now, as I mentioned, we need the ability to synthetically replicate, and also we need arbitrageurs, active arbitrageurs, to arbitrage any mispricing. Now, the rationale why we expect there is equal sign there is because if the future price is overpriced, we simply short future and take a long position in the underlying. If the future price is underpriced, we simply long the future contract and we short the underlying. And over time, we will get equality. All right? And here is another twist. If your forward or futures contract is written on an investment asset, such as stock, and if the stock is paying a known dividend, then in order to price the forward or future contract on that piece of stock, you have to strip away the dividend from the current stock price. Why you have to do that? Because in remember from your corporate finance course, the stock price would fall after the X dividend day, right? So when company announced, I'm going to pay out X amount of dividends, then the share price would fall by the exact same amount, the amount that equal to the dividend. The reason why people do that is because investors understand, if you keep that cash in a company that's reflected in your share price, if you pay that cash to the investor, that money is gone. Therefore, your share price have to reflect the fact that that money is gone. So when we're pricing the stock that pays a known dividend, you have to, right? So this is what you're doing in foundations finance. You simply subtract the dividend from the spot price of the share price. Then you do your normal thing. Then you multiply by e to the power of RT. All right, so the D is being the present value of that dividend income. Okay? So give you one example here. So think about the loan forward contract to buy a coupon-bearing bond, so a bond that pays the coupon, whose current price is $900. And we assume the forward contract matures in 9 months, and we assume the coupon payment of $40 is expected after 4 months. And we also told the 4 months and the 9 months risk-free rate are continuously compounded at 3% and 4% respectively. How do you price this coupon-bearing bond? How do you price a loan forward contract on this coupon-bearing bond? As I mentioned earlier, we have to strip away the dividend or the coupon from the current price. And we know, so this is a timeline. We know the coupon will be paid in month 4, right? How much it will be paid? It will be paid, so it will pay us $40, right? Now, we have to discount this $40 back to the present. How do we do that? $40 multiplied by E to the minus, so instead of positive, it's minus 3%, multiplied by the time horizon, so it's expressed as a fraction of a year, so 4 months divided by 12 months, and you get the present value of that income is 39.60 cents. All right? And you also told the current spot price for this bond is 900. So 900 subtract the income, the present value of that income, and you bring it forward, right? You bring it forward, so here, 9 months. So this 0.75 represents 9 months. So 9 over 12, that's 0.75. You bring it forward 9 months, and you get forward price on that coupon-bearing bond. And one thing to bear in mind is that in this scenario, the interest rate changes over time. So the 3 months interest rate and the 9 months interest rate are different. So when you do the discounting and when you do bring them into the future, be aware you are using different interest rate here, all right? So I put a little arrow here to indicate that we are using 4% for the 9 months continuous compounded interest rate. So any question on that? Okay. So this formula is dealing with the stock that pays a cash dividend. So this D is expressed in cash, in dollar term. However, in the real world, a lot of the future contract is written on stock index, right? So I mentioned this last week. What is a stock index? Stock index is a collection of stocks, right? So for instance, in Australia, we have ASX 200. So how do we select ASX 200? We have about 1,800 stocks listed in Australia's stock exchange. And we rank those stocks from number 1 to the bottom based on their market capitalization, right? So market capitalization is the ending share price multiplied by number of shares outstanding. We rank them, then we take the top 200 stock based on the market cap, then we put them into a portfolio and we call it, ASX 200 index. And the future written on ASX 200 is called SPY 200. All right? So how do we price the future contract for SPY 200? Well, there's the same issue that we're facing with individual stock, is that when you're holding that 200 stocks, each company would pay a dividend at a different point in time. What you'll be getting is you'll be receiving this constant stream of dividend throughout the year. And that dividend is expressed as yield, as a percentage, all right? So this little d here is the dividend yield. Now, remember at the synthetic replication example I give to you, we borrow some money, we buy the underlying, right? Okay, now you're holding the stock, you're holding 200 stocks, and they pay you a dividend. Guess what? I guess you can use that dividend to repay some of the loan. So that D, the minus D represents the dividend help us to reduce the cost of borrowing. So that's R minus D. Now, if you understand that, if you do that little adjustment, now we're able to price the future contract written on stock indices. So here is one example. So the question says, consider 6 months forward contract on an asset is expected to provide income equal to 2% of the asset price during a 6-month period, and risk-free rate of the interest with continuous compounding is 10% per annum, and the asset price is $25. And we also told, okay, so this is something you have to think about. So you were told 2% every 6 months, which means that's 4% for the whole year, and the compounding happened twice a year, right? So that's 4% with semi-annual compounding. Remember, before the break, I mentioned when you do the question, always convert them into continuous compounding the rate. How do we do that? We use this equation here. We know that the frequency is twice a year. That multiplied by the natural logarithm, 1 plus. So that's 2% every 6 months. So that's 4% divided by 2. And we get a continuous compounded rate is 3.96. All right? Then remember what I mentioned. You have to, so that dividend yield or that income yield help you to reduce the cost of borrowing. So that's why it's 25 multiplied by E raised to the power of 10% minus 3.96 and multiplied by half year, 0.5. So that is the forward price on that security. Here's another example, very similar. So here it says there's a 1-year future contract written on ASX 200. Sorry, that's a typo, ASX 200. And you told the dividend yield is 5%, and you also told the current value of the index is 3,529. I'd like to bring this to everybody's attention. This is not dollar value. This is points. Index is expressed in points, all right? So how does that affect our forward futures price? You take that points, so that's your spot price, 3,529. You multiply by E to the power of 10%, 10% is your interest rate, minus 5% dividend yield, and you get 3,710. A lot of people just finish right there. And if you do that, your answer is wrong, because the future price has to be expressed in dollar term. Now, the convention in Australia is that for every point, it's worth $25. So that's the multiplier you have to multiply with the points, okay? So 3,710 multiplied by 25, that is the dollar value. So always do that. Now, in United States, the indices, there are different conventions. So there's some indices is multiplied by $100, so each point is worth 100, and there's some indices that's worth 150. But in this course, our default convention is multiplied by $25, unless I tell you otherwise. All right? So if the question didn't tell you what is the multiplier, always multiply by 25. That's the convention in Australia, unless I tell you otherwise in the question. Okay? So just be aware of that. And once again, why we expect this two sides would equal, we expect the arbitrage activities would bring equality to this equation. Okay, there are some times that the future contract return on stock indices, there's sometimes this relationship doesn't hold. When that happens, now if you think about Black Monday, so Black Monday is a big market crash. Also, some people call that Black Swan event. So Black Swan event is a highly unlikely event, right? In a normal day, when you wake up, you think the stock market is just going to be normal. But then market probably crashed 20% in a day. So that's Black Swan event. Nobody expects that. Now, what happens on the Black Swan event is that everybody panic. So when they get panic, they start to sell their securities. So imagine the stock exchange receive a bunch of selling orders from everybody, and then no one is willing to buy it, right? So there's no one is willing to take the other side of trade. Then the liquidity dries up. Liquidity means that there's not simply buy volume to make up the transaction. So the market would freeze, and also it's called liquidity downward spiral. Now, if that's the case, then our capital F and spot price, this relationship doesn't hold. But that only occurs on a very rare event, such as Black Monday or other Black Swan events. All right, we also have the future contract written on foreign currencies. Now, imagine you are an Australian investor, all right? So Australian dollar is your domestic currency, and you are holding some US dollar, okay? So US dollar is the foreign currency to you. Now, let's say you're holding $1,000 and you deposit that US dollar in a US dollar denominated bank account, right? So just imagine you deposit that money in a US bank, right? So that US dollar denominated bank account would earn you some interest revenue, right? So that account would pay you the interest that denominated in US dollar. And you can think about that US interest revenue as, you can treat that in the same way as the dividend yield, right? So the IF here is the foreign risk-free rate. So that foreign risk-free rate reduces your cost of borrowing in a domestic currency. So that's why it's domestic risk-free rate subtract the foreign risk-free rate, right? So if you think about the interest revenue you receive from your foreign currency denominated bank accounts, if you treat that as a dividend yield, then simply use the domestic currency minus the foreign currency risk-free rate, then you can price the forward and futures that are written on foreign currencies. Okay, so here it talks about storage cost. We have been doing storage cost all the time, so I'll just skip that. So that's how you incorporate storage cost into the pricing equation. We've been using this all the time. And this is what I mentioned at the beginning of the class. I will not repeat. So what we have to be aware of is this equation sometimes doesn't hold for consumption asset. And the reason is because whenever you want to short sell the consumption asset, the owner of the physical asset may not willing to do so. If that's the case, then the misprice can persist in the market for a long time. And for that reason, we introduce the little y here, which is the convenience yield, to make the left-hand side equal to the right-hand side, right? So we talked about this at the beginning of the lecture. Now it comes to a very important stuff, valuing forward or futures contract. That will be on your quiz next week, all right? So next week, after your tutor cover the normal tutorial content, at the end, they will give you a little quiz, and it's going to be a question on valuing forward. So be careful of the terminology here. Whenever I'm talking about pricing, I'm talking about determining this delivery price for this capital F. Valuing is a different stuff. So why do we value forward contract? I think instead of me talking about this dry formula here, perhaps let's go through this numerical example. All right, so once you go through this numerical example, you'll be clear. What do I mean by valuing forward? Okay, so read this question. It says, a 6-month loan forward contract on non-dividend paying stock is entered into when the stock price is $30, and the risk-free rate of interest is 5% per annum with continuous compounding. Right? So when you read your question, your sense would pick up whether the interest rate is expressed in continuous compounding or whether it's expressed in nominal interest rate compounded at different frequencies. If it's not continuous compounding, convert it into continuous compounding, okay? Then the question asks two questions. The first one is, what is the forward price for this contract? And the second question is, what is the initial value of this forward contract? Well, we know how to price this forward, right? That's what we have been doing all along. The forward price is simply equal to the spot price multiplied by E to the RT. We know what the spot price is. The spot price is $30. That's what the stock is trading today. And the risk-free rate is 5%. So this forward contract happens 6 months later. So 6 divided by 12 expressed in a fraction of a year, and you get the forward price written on this non-dividend paying stock is $30.76, right? So it's really easy to answer the first question. What is the initial value of this forward contract? I'll tell you, when this contract is first initiated, it has no value. The value is 0. Why? Why the initial value should be 0? Not only that, if you think about in a more simple sense, anybody can enter into this forward at no cost, right? I can enter into this forward to buy this non-dividend paying stock at a price of $30.76. You can do it, everybody can do it. And there's no value because it costs you nothing to enter into a forward contract. So the initial value should always be 0 when you just initiate it. Okay? So this is what I mentioned here. The value of the forward is 0 when it was first initiated. Okay? Because everybody can commit themselves to buy this piece of share at a price of $30.76. Everybody can do it. Now, 4 months later, all right, so now we're in March, right? So 4 months later, let's fast forward to July, okay? So in this timeline, 4 months later, imagine we are now in July. Now, in July, what happens is that the stock price changed. The most updated stock price is $35. So in July, the stock is trading at $35, and the interest rate remains flat. So the interest rate is still 5% per annum, continuously compounded. So what are the forward price and what is the value of this long position in this forward contract? Okay, so we know how to work out the forward price. We just imagine somebody else. You know, this gentleman here, he wants to enter into a forward contract to buy the same stock 2 months later, right? So remember, going back to this question, we commit ourselves to buy the share in September, right? So today's March, 6 months later, September, and this gentleman here, 4 months later, he wants to enter the same forward contract to buy same stock also in September. So they have the same maturity date, okay? And he will get a contract. And the forward price in July, the way we'll calculate that is we'll take the spot price in July, 35, multiplied by e to the power of 5%, and be aware of the maturity here because he entered in July and he wants to buy in September, so that's 2 months later. So 2 over 12, all right? And he get a different forward price to buy the same stock. He get 35 and 29 cents. So what does this mean as the holder of this forward contract? Because I entered that 4 months earlier, right? So I'm holding the same contract 4 months earlier. I'm thinking perhaps at maturity date, what I can do is I'll commit myself to buy at $30.76. So that's the price which I entered into. I buy the same stock, and immediately I sell the same share to that gentleman there who wants to buy that in July at a higher price, $35.29. If I do that, I make a bit of money, right? And that's worth something. How much is worth? Because that cash flow only happened at a maturity date, we have to discount back 1 month, 2 months. We have to discount back to the present, right? Because the present is July. And that would only happen in September. So what is the value of my forward contract? Remember what I mentioned is that we are able to buy the stock at $30.76. So that represents the money going out. What is this capital K here? The capital K represents the initial forward price that we entered into 4 months ago. So that's the $30.76. Now, we are able to buy at $30.76, and at maturity date, we can immediately sell that to somebody else for a higher price, $35.29, right? So that's the positive sign in front of $35.29. That means the money coming into your pocket. So if you work out the cash flow difference, and you bring back 2 months, so multiply by e to the minus 5% to the power of minus 5% multiplied by 2, that's you discounting the cash flow back 1 month, 2 months. And that forward contract is worth $4.49. Does that make sense? Now, once you finish this example, let's go back to this notation here. Now, the convention of notation is that you would have a contract that entered some time ago, right? So in our example, we fast forward to July, we entered a contract 4 months ago back in March, and the initial forward price is using the capital K to denote it. Then 4 months later, of course, you have an updated forward price based on the updated spot price. So this capital F represents the updated forward price. And the difference is only happening at the maturity date. So that's why you have to discount it back. Right? So that is the formula for the long forward contract. Now, vice versa, for the short forward contract, you will get, so just imagine the very same question. If I change the long to short, the value of this contract will be negative. Why it will be negative? Let's go through this again. Imagine I just changed this question from long to short. Now, in March today, you enter into a short forward contract. You commit yourself to sell that share for $30.76. 4 months later, fast forward to July, if somebody else to enter into a short forward in July, they can sell at a much higher price. They can sell at a $35.29. So, right, so you're disadvantaged because you commit yourself to sell that share 4 months earlier at a lower price. And how much you lost? At a maturity date, someone else could have sold at $35.29, but you only can sell at a lower price, $30.76. You work out the cash flow difference. It turns out to be negative cash flow difference. And then you discount it back. So the value on that short forward is negative $4.49. So that's why, so the same equation for the short forward, the K become the positive K, then the capital F become the negative capital F. Does that make sense? Does that make sense? Or do you guys want me to go through this again? Put your hands up if you want me to go through this question again. So I assume everybody understood, right? Any questions with valuing the forward? It's actually quite straightforward, right? Any questions with valuing? Yes. Sorry, can you repeat your question? Lowercase f. Okay, so this, good question, very good question. So where does this lowercase f sits, right? So this lowercase f sits at this point, 4 months later, right? So imagine the time when we entered the forward is March. Now fast forward 4 months, 4 months later, now we're in July, and that little capital F is sitting in July. It's sitting here. Does that make sense? Yeah, exactly. So at that timeline, we're in t equal 4. We're valuing that 4 months later. No, it's not at the mature day. Because that's still in the future, remember? We commit ourselves to buy in September. Now we're in July. September is still 2 months away from July, right? So that cash flow would only occur in September. So it hasn't happened yet. Standing from July's point of view, that is worth the lowercase f. Does that make sense now? I want to make sure everybody understands the timeline. Make sure you draw the timeline correctly. Any other questions before we move on? Yes? Okay, so if you get updated the risk-free rate, Then you're using the updated future rate to work out the updated forward contract. Sorry, actually that will not happen because that's just getting too complicated. So in this course, when you're valuing the forward, the risk-free rate would remain flat. You will not come across a situation where the risk-free rate changes. But when you're using the risk-free rate, make sure it's continuously compounded, all right? Yes? Yeah, you can think about it as replacement cost. Yeah. Yeah. Yeah, you can think like that. So if that works for you, you can think like that. But I want to make sure everybody understands this will be, when you get the question would tell you this contract has been entered some time ago, all right? And this contract has not matured yet. It will mature in some time in the future. You're in the middle point, and you're valuing this contract. Does that make sense? Can we move on? Can we move on to the next question? Okay. Good, we understand the valuing. I will not talk about the delivery because I talked about the delivery last week. Let's talk about hedging strategies using futures contract. Now, last week, we've done one hedging with the bitumen futures contract, which was a perfect hedge. That only happened in an ideal situation. But today, we are going to go through some more realistic example here. All right, so if we think about hedging, right, so that's what I talk about. A perfect hedge is the one that completely eliminates all the risk. So if you enter into long futures contract to buy 500 tons of bitumen at a price of 32,000 RMB, at the end of the day, if your net cost comes down to 32,000 RMB per ton, then that's called a perfect hedge, okay? But in reality, that sort of situation rarely happens, okay? It's small chance that the perfect hedge happens. Most likely you end up with an imperfect hedge. I mean, why that's the case? So before I elaborate on that, I want to make sure everybody understands my terminology. So when I talk about a short hedge, I mean I'm hedging with a short position in the futures contract, futures or forward contract. So what kind of people would use the short hedging is somebody who already owns the asset and wants to sell the asset in a future date. Imagine you are a live cattle farmer in Australia. You already have 200 live cattle and you wish to sell the live cattle in a future date. But you're worried that the price of live cattle will drop. What you do is you can enter into a short position today. If the live cattle price drops, no pressure because you're making some money in your short position, right? So short means you're making money when price decline. Long hedge means that you're hedging with a long position in either a forward or futures. So that is used by somebody who has the intention or who has the demand to acquire the underlying assets. Remember last week when we go through the example of the bitumen futures contract, we as the construction company, we need to buy the bitumen in 10 months' time. We have the intention to buy it. In that case, we worry the price of the bitumen to go up. So we hedged with the long position, right? We enter into a long bitumen futures contract. If the bitumen price increase, we make some money with our long position, and that eliminates the risk. So that's called long hedge and short hedge. All good. And there are some arguments that in favor of hedging. Why people should hedge? There are arguments for it. So imagine Qantas, right? Qantas is the airline that operates in Australia. And the one single biggest cost for Qantas is its aviation fuel, right? They worry that the aviation fuel price will go up. So if they worry about it, then they are, they're concerned about this risk. They cannot make their attention, they cannot focus on their main course of business. What's their main course of business? Their main business is to serve the customer, right? Their main business should be figure out how can we serve the customer, to the absolute best. So that's their main business. Now, if we have the hedging tool in place, allow Qantas to hedge off the aviation fuel price risk, they don't have to worry about the aviation fuel price go up or go down. They can just do what they do best, which is serving their customers. So that's the argument in favor of hedging. Company should focus on the main course of the business that they are in. All right, and there are arguments against hedging. The argument against hedging is following. So think about who holds the Qantas share. Shareholders, right? Shareholders would hold Qantas share. And in foundational finance, you were told that the investor holding a diversified portfolio. Investors should be holding a market portfolio. What does market portfolio mean? Market portfolio is a portfolio that consists of the stock in the market. Something like an index. You can think of that as index. Now, if I'm already holding, all the stock in the market, then I shouldn't be worrying that Qantas is subject to aviation fuel risk. Why? Because if the Qantas this year made a loss because the aviation fuel increased, my oil company stock share price went up, right? Because oil company benefit from a fuel price increase, so that would cancel each other out. As a shareholder, I'm still doing fine. So why should Qantas spend, waste my money to hedge? So that's the argument against it. But at the end of the day, company still should hedge. Why? Because although you're holding a diversified portfolio, but imagine that Qantas did not hedge and made billions of dollars of loss. Made a loss. And what happens is that other grumpy shareholder would use the right to vote out the current management team. They have the right to replace the board of directors. If they do that, all sort of uncertainty happens. Qantas can be acquired by another aviation company, and then you are exposed yourself to uncertainty. So at the end of the day, the company should still hedge. Okay? So there are just two arguments for it and against it. Now it comes down to another very important concept, basis risk. So what is basis risk? So in plain language, basis is the difference between the final spot price and the final futures price. All right, so let's have a look at this graph. So for those who was not able to access the audio last week, it's a perfect time for me to recap what meant by convergence. All right, so imagine now it's January. Let's just imagine now it's March, okay? So now it's March, and we commit ourselves to buy 1 ounce of gold in 6 months' time, which means we're going to buy the gold in September. All right? And today, I work out a future price based on today's spot price. Right? So I simply take today's spot price and multiply by E to the power of R plus Q and multiply by the time horizon. And then you will get a future price today. And that future price will be greater than the spot price. That happens 95% of the time. So in a normal market. As you're moving through the time, the future price fluctuates with the spot price. But in maturity date, in September, all right, just imagine 1 hour before that contract expires. Just maybe 1 hour before that contract expires, if somebody else wants to enter into that futures contract to buy 1 ounce of gold, then that future price has to equal the spot price at that time. What happens if it doesn't equal? Well, if the future price ends up being higher than the spot price, imagine that contract just 1 hour before it expires, and you know that future price is overpriced. Then as an arbitrager, you would want to enter into the short futures position, right? You want to short that future contract at a higher price. And all you need to do is simply hold that contract for 1 hour, and 1 hour later, you can buy the gold at the spot market for a lower price, and immediately sell that under your short commitment for a higher price. If many people do that, that would push the future price down and eventually converge with the spot price. And vice versa. If the future price ends up being lower than the spot price, an arbitrager would love to take a long position in that futures contract. All they need to do is they hold in the long futures contract for an hour, and an hour later, they commit themselves to buy the lower price and immediately dump that gold into the spot market for a higher price, and that would push the future price up, and again, we'll get a convergence. So this is the convergence, right? Okay, so why we have basis risk? Basis risk happens, so think about you want to buy the gold in September, but because the future contract is highly standardized, let's assume there is no future contract written for September delivery, and all you can get is a contract that delivery on July. Then you have no choice but to enter into that July contract, because the July contract is the one the most close to the September one, right? So you actually need the gold in September, but you are forced to enter into a contract in July. Then there is a gap between the future price and the spot price. Then you will not get a perfect hedge, and you will get an imperfect hedge. And how imperfect is that? How imperfect of the hedge is measured by the basis, the difference between the future and the spot. Now, just talking like that is quite abstract. So how about we go through one example? Don't worry about this notation for now. We're going to go through the numerical example first, and we're going to come back to this notation stuff. All right, example says, on 1st August, you entered into a long future contract to buy 1 ounce of gold on 31st December, all right? With delivery price of $650 per ounce. And the spot price on the 1st August is $620 per ounce. And what is your initial basis? All right? So your initial basis, going back to this graph here, will be the difference between the future and the spot, right? So we know what the initial basis is. The spot price today is $620, and delivery price $650. So the difference is minus 30, right? Why is minus? Because in the normal market, the future price is always higher than the spot price. Very straightforward. So that's your initial basis. And remember, in a perfect hedge, this initial basis should converge to 0. You end up with a perfect hedge. So let's look at the scenario number 1, the ideal scenario, the perfect scenario. All right? So you held this contract to the expiry date, which is 31st December. And the spot price on 31st December is $670 per ounce. And what is your final basis? Remember, if the spot price on 31st December on the maturity date is $670, then the contract just before it expires should equal to the spot price, $670, right? So that's what happens with this graph here. You should equal to $670. If it's not, then arbitrager would bring them into the convergence. So for that reason, we should expect the future price is also $670. Now, what is your final basis? So I use a different notation to denote final basis. So the S2 means the spot price at the end, and the F2 means the future price at the end. Now, if you work out the difference, you realize your basis is in fact 0, right? Okay, so now let's work out what is the effective price that you spend to acquire that 1 ounce of gold. So this question says, what is the effective price that you paid with this long hedge? Well, first of all, in December, okay, assume we don't take physical settlements, all right? So we do cash settlements. In the December, what you do is you still go to your local supplier to buy that 1 ounce of gold at spot price $670. All right, you pay $670. And that's not your real cost. Why? Because you actually made some money in your futures, in your long hedge, right? How much did you make? So you lock yourself to buy at a price of 650, and you're going to close it off at a maturity date by shorting the very same contract on the very same maturity date at 670. Right? As I mentioned, the future price should converge with the spot price at the maturity date. So you bought at a 650, so that's the minus sign, and you sold at 670. You made $20 gain on your loan hedge, right? You made a $20 gain on your loan hedge. So effectively, what you paid is 670 minus the gain that you made. So your total cost is 650. And remember, what is the cost that we wish to lock in? We wish to lock in 650 on 1st of August, and we managed to do that, right? So that is a perfect hedge. That's where the basis, that's where the basis is 0. That's where you're holding this contract to the maturity, and you close it off on the maturity date. So we end up with a perfect hedge. But remember, I said this is the rare event. The most likely event is you're going to end up with an imperfect hedge. So here comes to scenario number 2. The question says, instead of holding this contract to its maturity, you decided to close it out early. Why do you want to close out early? Because your company actually needs the gold on 30th of November instead of 31st of December. All right? However, because the standardized nature of the future contract, let's assume there's no future contract available on 30th of November. So the only choice you have is the 31st of December contract, because that's the one that most close to the need, right? Most close to the date that you need the gold. So that's what you did. So the only choice you have is the 31st December contract that you've entered into on 1st of August. Now, on the 30th of November, you have no choice because you need the gold on that day. So you're going to spot market to buy the gold at a spot price of 660. And remember, you have to close out your futures contract on the 30th of November as well, right? Because November is here. Because November is here, right? So November is not December. So there's still a gap between the future price and the spot price. So what is the effective price that you paid? Okay, so you paid 660 to buy that 1 ounce of gold in 30th of November. And you closed off your contract on 30th of November as well. So what we were told is that the future price of delivering of gold on 31st of December is priced $665 per ounce on 30th of November, right? So imagine you're standing here, you enter into the loan futures contract that would commit yourself to buy in 1 month's time, and that future price is $665. So how much money did you make on your futures contract? Of course, you're going to close off your contract by going to the opposite direction. Originally, we went long. Now we're going to close off our contract by going short. So we're going to short our contract. We're going to short the contract at a price of 665, and we originally loaned the contract at a price of 650. So that's $15 gain on your loan hedge. So effective price that you paid to acquire that 1 ounce of gold is 660 minus the gain that you made on your loan hedge, 645. But wait a sec. We tried to lock in a price of 650, but we end up with 645. In other words, the effective price you pay to acquire the gold does not equal to the price that you locked in on the 1st of August. And that is imperfect hedge. It's imperfect because the effective price you paid does not equal to the price that you locked in. The reason why we have that $5 difference is because you closed out your contract early, right? You, instead of closing out on the 31st of December, you closed out on 30th of November. For that reason, we have an imperfect hedge. Okay, so I will come back to this equation later, so don't worry about the notation for now, because I will cover the same question, a different question, but similar question in the workshop this Thursday. But for the moment, just let that sink in, right? The reason why you have an imperfect hedge is because you close out your contract early. The reason why you close out early is because there's no contract that delivery on the 30th of November. That's what's going on in the real world. All right, so that's one way you can get basis risk. And the second way you can get basis risk is that there's no future contract written on the underlying asset that you wish to hedge. So what do I mean by that? Guys, just last 10 minutes, let me quickly go through the cross-hedging, and I'll talk about hedging with the portfolio in the workshop, okay? Just bear with me for the last 10 minutes. So another way you can have basis risk is you are hedging, so the underlying asset you wish to hedge, there's no such future contract available. So a typical example is that an airline company would want to hedge their risk in the aviation field. But the aviation fuel futures contract is thinly traded. There's no liquidity in the aviation fuel futures contract. And there's, in a lot of exchange, there's no such thing as aviation fuel futures contract. So what airline company doing is they have to using the future contract that written on heating oil to hedge their price risk on the aviation field, right? So in other words, you're using the future contract written on a different underlying asset to hedge your risk exposure to the aviation field. So that's called cross-hedging. Now, cross-hedging would also expose you to the basis risk. All right, and here's the formula to calculate a hedging ratio, right? So the hedging ratio tells you, hedging ratio help you to calculate the contract size that would largely remove your risk exposure to the aviation fuel by using the heating oil future contract. So let's have a look at one example here. So let's just quickly skip that. Let's go through this numerical example. Then I'll come back to this equation in the Thursday workshop, okay? So the question says, an airline is expected to purchase 2 million gallons of jet fuel in 1 month, and it decides to use the heating oil future contract to hedge the risk exposure they have in the jet fuel. So based on the historical data, what you're able to calculate is you're able to calculate, the standard deviation on the trend, so the standard deviation on the futures price over past 15 months is this much. And the standard deviation on the spot price on the jet fuel is this much, based on the past 15 months of historical data. And correlation between these two fuels is very high, 92.8%. So that's the correlation. Rho stands for the correlation. And the question asks you, what is the optimal hedging ratio here? And based on this formula, we know that the spot price for the jet fuel, we know that standard deviation for the jet fuel spot price is this much, and use that to divide by the standard deviation on the futures price, and then multiply by the correlation between them. You get a ratio of 0.777. Okay? And each heating oil contract traded on SX is on 42,000 gallons of heating oil. So your total exposure, remember, we wish to hedge 2 million gallons of jet fuel. So that's our total exposure, and that's how much per contract is covering. So per contract is covering 42,000 gallons. And you divide by that, but that's not real number of contract you need to use. Why? Because the heating oil is different from the jet oil, and you have to adjust that by using the hedging ratio that you